Hi, Lynn. How are you?
Pretty good. How are you?
I'm very good, thank you. Very excited to be traveling again soon. I go to Miami next Sunday, so I'm very excited about that. Okay, as ever, there's loads to talk about. I've got so many notes this week, got lots to talk to you about. I want to talk to you about volcano bonds at some point because I've got so many questions that you probably have better answers for me. But can we start on currencies? Because I've been tracking regularly over the last year what's been happening with the Turkish lira. And also, my brother raised to me that Hungary is having issues with its currency this morning. Um, so, are we potentially going to be seeing more currencies collapsing? How much are you tracking the various currencies around the world right now?
So I track about 30 of them probably. Not every single one. For example, I don't track Hungary very closely. Turkey's one I have been tracking. And the issue that you see generally in a lot of these emerging markets that have currency issues is that they have not enough foreign exchange reserves compared to their dollar denominated debts. And the difference between Turkey and Argentina is that Argentina, most of that debt is on the sovereign level. The private sector is actually relatively unlevered. Whereas Turkey, it's the opposite. So the sovereign's actually pretty unlevered, but it's a big corporate debt problem, and so they have a lot of U.S. dollar financing, and a lot of it's connected to European banks, and then also because they don't really have independent central banking, right? So the leader keeps firing the head of the central bank, and so they're basically not having kind of independent experts try to quell that inflation. It's unclear if that would even help, right? I mean, it's not always helpful, but basically, there's multiple problems there, and so Turkey's been on my list of like bottom ranked currencies for a while, and a couple times it looked like they might have stabilized it and turned around, but then they go ahead and break again. And so Turkey is at risk of a ongoing inflationary problem and currency devaluation problem. And the thing is, they have good underlying fundamentals. I mean, they have they're a strong manufacturing base. They obviously have great geography. They have good demographic trends compared to say Europe, for example. So they have a lot going for them, but they have clearly some dysfunction there that's really hurting their currency. And this generally goes in cycles. So every time the dollar has a strong cycle, so it had a strong cycle in the 1980s, it had another strong cycle in the late 90s, and then it's been in this third cycle for the past 5 years or so. And every time it's in one of those cycles, it usually breaks certain emerging markets. So in the 80s, it was Latin American countries. In the late 90s, it was the Asian financial crisis and Russia. And then this latest one is more spread out. So it's Argentina again, it's Turkey, it's Lebanon, it's a bunch of these countries with no specific geographical kind of descriptor.
Right, but why? Sorry, why specifically is that happening to these specific countries? Sorry, I don't really understand.
So it like again, it depends on the specific one, but generally they are ones that did not invest very well, and so they did not build up sufficient foreign exchange reserves.
Okay.
They build up too much dollar denominated debt, and then usually have some sort of political dysfunction, right? So Argentina and Turkey, very different political environments, but neither of them could be considered a particularly well-oiled machine at the moment. Whereas right now, for example, Southeast Asia is not really having major currency issues at the moment, right? So they have their own political issues, but they didn't really run into the specific problem right now of having too much dollar-denominated debt compared to their reserves and other types of issues like that.
Right. Okay. So this is tied to the dollar itself.
Partially, the dollar is a catalyst, and
Mm,
so basically, when you take on dollar-denominated debt, if that dollar weakens, that's good because it's like if I took out a mortgage in pesos and then the peso goes down, right? That's good for me. Um, but if I take out a mortgage in pesos and the peso doubles compared to the dollar, well, my income is still the same in dollars. I have a problem, and so that's what corporations and governments do in emerging markets. And so if the dollar strengthens, that's generally kind of like quantitative tightening into a recession, right? So instead of them having easy monetary policy, their central banks are trying to tighten to stabilize their currency, and they have liabilities that they can't print away, and so they kind of fall into a spiral.
right. But this is Turkey also printing money like other governments are printing money, which is driving their own inflation.
Yes, they have very, very strong money supply growth at the current time. That's been a big contributor. and they don't really have their budget deficit under control. But again, they don't have a lot of like say stored up government debt. It's really that their issues more in the corporate sector. But yes, overall, you have rapid money supply growth, and then rapid price increases, and then you don't really have positive real rates either. So there's less incentive for people to want to save or for foreigners to want to come and backstop the currency.
See, what amazed me with Turkey is that they were targeting now, is it they're targeting 5% inflation? So their target is actually still what we would consider very high here.
Well, yeah. I mean, right now they have well into the double digit inflation. So for them, 5% would be a huge improvement compared to what they are now. So if anything, it's a somewhat realistic attempt rather than saying we want zero inflation from double digits. But clearly they want it directionally lower. But yeah, it's funny. Even 5% would be very, very high. Now the difference is if they have 5% inflation, their rates wouldn't be zero like we have in say the United States and the UK. So you'd have a different environment there. But yeah, you still have high inflation.
Wild. Okay, so what's going on with the bond market? I was reading something at the FT this morning, something by Daniel Fuss, the chairman of Loomis. He was saying it scares me when I see what is given up in terms of natural prudence and caution. We'll have to wait and see how things play out, but the reach for yield has overridden the fear factor. I was also talking to Greg Force recently, and he said that there's no logical reason for people to be buying bonds now. The yields are 1.4% on US Treasuries. Yet with an inflation rate of 6.2%, you're essentially negative yielding close to 5%. So he said anyone buying these is a moron, but the reality is some people are mandated to. So are people just having to buy something they know that is negative yielding?
Pretty much. I think there's a variety of reasons, and this has been one of my core themes going into this year is the idea of financial repression. So high inflation, but not correspondingly high interest rates. And I often use that comparison to the 1940s that we discussed before, because that was the big difference between the 40s and the 70s. Is that in the 70s you had high inflation, but you had high rates as well, whereas in the 40s you had high inflation without high rates.
Right.
Because a lot of the current situation looks like the 40s, we're basically at a financially repressed environment. So we have this high inflation rate, but central banks are still holding their short interest rates low, at zero roughly, and then long duration rates. They buy a lot of those bonds to take off excess supply from the market. They create collateral shortages. And so you have the situation of positive yield curves in many environments, but very very low, suppressed well below the inflation rate. And the interesting thing is you even see junk bonds on average now have a negative real yield, which is like, I think might be the first time in modern history where you're not even getting fully compensated. Now, some of this is because of mandates. There are large pools of capital that have to buy bonds. They're regulated to. And then also, I mean, there are still institutions that believe it'll be transitory and that believe that it'll kind of normalize. Then you have retirees and things like that they're not mandated to own bonds, but they would, maybe they're 80 years old and they would feel uncomfortable being 100% in equities and be exposed to that volatility. So they'd rather have part of the portfolio lose money slowly than have 100% of it in equity. So it's across the board different reasons. But I would say, yeah, we're certainly in a period of financial oppression where bonds are probably going to have negative real yields for most of the time going forward for quite a while.
So I was reading this morning in Bloomberg that Morgan Stanley was saying that you should be staying away from US stocks and bonds next year and seek out better returns in Europe and Japan. Like I'm assuming we're in a very unique time where the hunt for yield against the backdrop of high inflation is making the jobs of these people super difficult. Like, what other options do people have?
So it depends on the pool of capital. For example, there were regulations that made money market funds hold more treasuries rather than corporate paper. And that's an example of kind of shoveling people into treasuries. And so we also see that banks, because they're not really lending too much, they've been buying treasuries. They've been net buyers of treasuries on average. And then also you have insurance funds, for example, have to hold a lot of their float. They're basically they collect premiums and then they pay out claims and they hold a permanent float. So depending on the insurance company, generally billions or tens of billions of dollars of investable assets, and they basically get to earn the income from that, but they have to keep it super safe. And so some insurance companies are 100% bonds, and they might do mostly government bonds, but then also some municipal bonds and some corporate bonds. And then you have a handful of them that can put some of it into equity. So, for example, Berkshire Hathaway, Warren Buffett's company, does that. I also know that Cincinnati Financial, for example, does that. There's some insurance companies that venture out. We've also seen actually a trend of some insurance companies buying Bitcoin. That's been one of NYDIG's big kind of approaches. But overall, insurance companies are very bond heavy by because they have to. They have to match those. They have to have basically low volatility and match their liabilities to their expected payouts. Um, so a lot of this is mandated. But then you see, there are pools of capital that have some more flexibility, and then they go out on the risk curve trying to get more yield, and that does come with risk. And so, for example, pension funds they target like 7 or 8% returns, which is hard to do when historically they've been bond heavy portfolios, and bonds used to yield 5, 6%. So you had bonds, you had equities, and you could make 8, 9, 10%. But now with bonds so low, they've been allocating elsewhere. So they go into private equity. They go into some leverage things. We saw, for example, that California's pension they actually levered up a little bit. They basically levered up 5% of the portfolio to buy some of their riskier assets. They kind of increased their risky exposure, and that's an example of these pools of capital that have some flexibility being pushed out on the risk curve because instead of just having some of their portfolio in super safe assets, they increasingly want to go into these other areas because they have certain targets that they have to reach. And so it's a really problematic environment. It's kind of like when you squeeze all the juice out of the orange. We've propped up asset prices so high that now we're starting to see kind of improper behavior as people would say, well, I can't own bonds, so I have to own riskier things. And then they deal with that volatility.
What are those riskier things though? And they're not just like riskier bonds in other countries like South American countries. Are these other assets? Are these corporate investments?
There's different types. So one is the simplest one is simply that they own more equities, right? So they just have exposure to equities, which of course can have large drawdowns, compared to bonds. Then the other options are they can go into private equity, so less liquid investments, things that they can't necessarily cash out quickly, but they expect to do good returns over 10 years, which they might or might not get. Then they can also get into corporate financing. So in addition to just buying some, say, safe corporate bonds, they can also go into like funding bank loans and other types of financing for firms that are, might not be investment grade. So junk bonds essentially and junk loans. Um, then they can go into like levered products where you borrow a little bit, but then you lend at a higher rate with some credit risk. They can buy emerging market bonds as well, so they could that's a source of higher yield with more risk. And then you know it's kind of just those different types of things. So either loans, equities, um, or just different types of riskier bonds. And that's the overall risk is that they go into things that have more probability of permanent capital loss in a nominal sense. And also more volatility, so they can have a 20% downturn in a portfolio that is supposed to be pretty safe. So you can imagine, for example, an 80-year-old might not want to be 100% in equities. They might not want to be exposed to the possibility of a 40% downturn in a year. And traditionally, they've been advised to have more bonds exposure. But with bonds being such a bad investment, they find themselves between a rock and a hard place, and then they often want to buy, more equities. And so I think it makes sense in some ways, but it does come with risk.
But can they buy Bitcoin?
Yeah, they can buy Bitcoin, and that's something I've been advising since 2020. That basically that people have different numbers for how much Bitcoin's right for them, but zero is not the right number for most people anymore. And so for obviously some people super high conviction, they don't want to own anything other than Bitcoin. And they're willing to accept, crazy drawdowns and crazy, doublings and triplings in price. Whereas obviously other investors with maybe less conviction or less volatility tolerance, for them it's putting Bitcoin as some non-zero position in their assets. So they might take some of their bonds and put it in Bitcoin. So even if you have part of your portfolio is a melting low volatility ice cube, you have this other part that over the next 5 years, hopefully rapidly appreciating in price and kind of balancing some of that out. So you have kind of that mix of low volatility without necessarily losing value. So there are different strategies like that. I do think more of them should probably turn to Bitcoin. We've seen some pensions get into Bitcoin, but they've been somewhat slow. They preferred, I guess, more levered kind of Wall Street products than Bitcoin so far. But I do think overall the Bitcoin would be a better choice.
But what about volcano bonds?
Well, I mean, yeah.
What did you make of that?
Well, I think it's so they're basically doing the kind of like the Michael Saylor playbook for a country,
Mm.
right? So they're issuing debt. My understanding is in dollars and using that to buy Bitcoin and buy Bitcoin mining equipment. So if that pays off, that could be tremendous, right? I don't know what the yields will be. I haven't looked into the full details. I think they're doing it partially over liquid,
6.5%.
6.5%. Okay.
Yeah, that's what they're offering.
And so yeah, basically that's classic for emerging markets, and it's tricky because their normal debt is not really considered investment grade, which is the case for many kind of smaller emerging market type of countries. And so this one is obviously it's more backed by clearly what they're investing into. So overall, I think it's constructive. I think it's a pretty smart idea. Um, and it's one of those things where if Bitcoin goes up a lot in price, and if they bring in the right expertise to have effective rates of return on their mining equipment, in that environment, that could work out really well for them. My understanding is that obviously geothermal is very attractive energy to use. The climate is not super ideal for Bitcoin miners. And so overall, you generally would want to have experts there that make sure that it makes financial sense at the end of the day. When you take into account the construction costs, the expected return on investment for the miners, the low energy combined with the fact that it is hot and humid. So overall, I'm again like most things out of El Salvador. I'm always like I'm interested in that. I'm hopeful for that. I'm bullish on that. But there are risks.
As I remember, I could be wrong, but I'm pretty sure I saw it. It's a 6.5%. You call it a coupon, right?
Yes.
I like that. And I think there's a 5-year lockup. And what they said they were going to do is they were going to spend half of it on Bitcoin, and my assumption is the rest is used for other projects, maybe mining. But if they're buying $500 million of Bitcoin with a 5-year lockup, I guess their thesis is in 5 years' time, Bitcoin will be worth more, and therefore, if the debt's denominated in dollars, then if Bitcoin does a 5x, I mean, that's not going to be like there's little risk to them. But I think it feels like they're playing the Bitcoin continues to go up in price game. That every cycle will continue to see a multiple X increase.
That's similar to how Saylor structured his capital structure. And so they did a couple rounds in MicroStrategy. And the first rounds were like convertible. So there's super low interest rates, but then they can dilute the equity. And then I believe the final bond round they did was basically I think it was something like 6%. Basically, it was a bond that had a pretty high yield. And the expectation was, if Bitcoin goes up substantially over the next 5 to 7 years, it more than compensates for a 6% up, cost. And they, their lockup period, like their duration of those bonds, it varies a little bit, but it was I think like 5 to 7 years. And then they switched to issuing equity in order to buy more Bitcoin. So the fact that El Salvador is kind of doing a similar timeline, I think, makes a lot of sense. A lot of Bitcoin investors say, for example, that kind of 5 years is probably an ideal timeline where you have a high probability of getting returns out of it. Historically, anyone who invested for 4 years made money, usually less, but that's kind of, if you invested for 3 or 4 years, you made money, even if you bought it at major tops, for example. Now, that's not, it's one of those classic, disclaimers like the past is no guarantee of the future. So there's no kind of guarantee it has to do that for the next 4 or 5 years. But overall, because he's locking in that longer term debt, it is a smart thesis if someone's super high conviction on Bitcoin, which obviously El Salvador's president is.
So with that 5-year lockup, or referring specifically to Sailor, will he have to sell the Bitcoin at some point to pay the bondholders?
Not necessarily. If Bitcoin if it goes up or stays roughly where it is, the most likely bonds would be refinanced, right? So when the bonds come
Okay.
due, you just issue another bond offering to cover them. The only time where it gets messy is if, let's say, Bitcoin does go down quite a bit, right, over 5 years. So some sort of catastrophic outcome for Bitcoin, and Bitcoin's down in price, and the market is spooked by that and doesn't really want to finance those bonds anymore, doesn't want to refinance them. And so it's possible that the company would have to issue equity in order to kind of cover its expenses, or it could potentially sell some of its Bitcoin. So generally, in a good environment, the answer is no. Something would probably have to not have worked out very well.
Okay, so even with El Salvador, they would constantly look to refinance these bonds, and I think they've talked about potentially issuing 10 bonds, $10 billion bonds over a certain period. I guess the game theory is if this proves to be correct, other people will start issuing Bitcoin bonds. Is there any risk? Do you see any risk here that there would be too many people trying to enter the Bitcoin market to issue bonds?
Well, I mean, so enter the Bitcoin market, like buy Bitcoin by issuing
No,
bonds.
issuing bonds to buy Bitcoin. Is there any kind of like systematic risk we build up with this?
If it gets big enough, yes. So one of my concerns that I've been watching more so than that type of bond is the collateralized Bitcoin lending. And so far, that's a small percentage as far as I, can kind of piece together from some public numbers of, say, Bitcoin's realized cap, for example. Now, the issue is if that amount of debt gets super high, if that becomes super common to do, everybody kind of takes out loans against their Bitcoin. Then the issue is that everybody has kind of a liquidation point around the same level, right? So let's say they like 30% loan to value is common, right? So let's say Bitcoin has one of its gigantic drawdowns and it goes down 70%, but then it triggers the fact that, so many people have these collateralized loans where Bitcoin loses 70% of its value, is subject to liquidation, and then you can have a self-fulfilling loop where more Bitcoin keeps getting liquidated in order to finance these debts, and that causes more entities to have to liquidate, and because the debt is too high relative to the amount. Now, I think we're a long way off from that, but that's a risk. Now, it's a little bit less risky with bonds because if they're non-callable, if they're basically just they have a fixed term that goes out years, and they're all going to be issued at different times, so they're going to be staggered in different ways. I think that's normal. Kind of like how there's a lot of debt tied to real estate, and it's one of those things where it can, because real estate is pretty low volatility, it can withstand quite a bit of debt connected to it. Now, some places do become excessive. I mean, China's an obvious example, but also parts of Australia, parts of Canada, parts of Europe, and then lately parts of the U.S. Become rather excessive with how like the valuations become propped up, and then there's a lot of debt tied to that. So if those valuations ever go down, that becomes a structural problem for that country's GDP. Now, again, Bitcoin is a long way off from that. I mean, if you add up all the debt out there that exists, that is in some way used to buy Bitcoin, that's still a very, very small number in the grand scheme of things. So I think that process probably has a much longer runway to go, before I'd be concerned about that.
Just so I can understand a little bit more about how this works. So if they issue this $1 billion bond and has a 6.5% coupon, that's $65 million. My math is correct. Is that something that's paid annually? So they essentially have to generate $65 million to pay the bondholders annually.
So it would depend on how that bond is contracted, right? So basically, I could have read up more on it, if I knew we were going to go into detail. But
Sorry.
essentially, no, but essentially, the common thing is say payable twice a year.
Okay.
So generally they would pay 65 million a year, spread out in two payments. That'd be common. Now theirs could have different terms. Generally, some short duration bonds they don't pay interest. They instead just they basically issued it at below face value and then pay out face value by the end. Whereas these longer ones normally do have interest payments. So probably twice a year. Um, and yeah, they have to have dollars to cover that. Now they could issue more debt to finance that, but then it depends on how much the market is willing to take before they consider it a major credit risk, right? So if they were to keep increasing their debt faster than they're getting results, the market might balk at that. But also, I mean, they do have dollars, and they do have incoming. They do have basically activities that they can draw from. So yes, but they have to make sure that they can cover those interest payments.
So the play here seems to me, and tell me if I'm incorrect, but yeah, they issue $1 billion bond. They spy $500 million of Bitcoin, of which they hope or predict over the next 5 years that might itself do a 5x or something or other, which gives them yeah, $2.5 billion, let's say, of Bitcoin. The other half a billion, say they spend that on mining infrastructure, and as long as that generates $65 million a year of profits, that pays the bondholders, and then come 5 years time, they could refinance the bond and continue to do that as long as they can continually pay that 65 million a year. Yet they're set on the backdrop of this ever growing value of Bitcoin. So it seems quite smart, really, as long as Bitcoin continues to go up forever.
It's a very similar play to what a lot of entities do with real estate, where you
Right.
never sell the real estate, you just keep refinancing it over time as it goes up in value. And Bitcoin is basically a more volatile version of that. Obviously, it's got less track record, 13 years, but the potential gains, if you're right, are massive. And this is kind of the game theory of say different countries where El Salvador has less to lose in some sense. They basically have already have economic issues. There's a variety of problems there that they're trying to solve. And so if they're right about this, um, that really moves the needle for them. If
Yep.
they issue dollar-based liabilities and they buy Bitcoin, and if they start cutting down remittance costs, with their whole kind of Bitcoin legal tender laws, and if they do attract more capital and more people that want to go there, that could be a huge boon. That could be a giant turnaround. Bitcoin doesn't even have to go up 5x in order for that to pay off. If it doubles over 5 years, that would still pay off as long as it
Mm.
goes up more than 6 or 6.5%, whatever the number is. Let's say we want it to go up more than 10% a year for the next 5 years. That should have covered itself. And of course, if it goes up 5x or 10x, that's a huge game changer for them, especially compared to other countries in the region and basically, their peer countries.
Yeah. So the only risk to them, like you say, is a collapse in the price, whereby they couldn't and if they couldn't refinance the bond, is that a potential? And at that point, do they then have to sell their Bitcoin to pay out the bondholders? Like, what happens when a bond can't be refinanced?
Well, so one option is they default, which
Yeah.
is, they just say we can't pay you back. Um, Generally, with countries, there's like restructurings, or they'd have to sell their Bitcoin, sell other assets. They might have to sell an interest. Like let's say I don't know, if they have that state-owned energy company. I don't know the exact legal structure, but for example, you could privatize that, right? So you could sell that, raise capital, pay off the bonds. So there's a variety of ways that they could finance it. Um, and generally you want to avoid that situation because you don't have to sell something at an inopportune time. You never want to have to be forced to sell something because then you're price insensitive seller, right? You just accept whatever valuation you can get. If Bitcoin's down, they might not want to sell when it's down, but they might have to. And so yeah, that's generally a situation to avoid. But you have that kind of the combination outcome of either defaults or selling valuable assets in order to cover liabilities.
See, this could inspire other countries to do the same, especially in the region. I know, for example, Paraguay is very interested in using their hydro dams to mine Bitcoin, but other countries in the region could see this and say, "Hold on a second, we can do this. We can issue similar bonds." And if this becomes something that a lot of other countries start doing, it becomes a self-fulfilling prophecy because it takes so much Bitcoin off the market. Then the thesis is proved correct.
It's also, I mean, that some people have been talking about that. Why don't some large countries just print a little bit of money and buy Bitcoin and stick it on their reserves, for example? And if you were to see like that those cracks in the dam start to appear and you start to see that happening, that's potentially a really explosive moment where you could have hundreds of billions of dollars of different types of liabilities issued in order to buy Bitcoin, which then is so big for the market that's still kind of small. And we still see, I mean, even though right now, for example, as we talk, Bitcoin is in somewhat of a correction, we still see that the exchange balance of Bitcoin is hitting like multi-year lows. And it's just because there's not a lot more being created. Obviously, it's pretty late in its distribution schedule, and there's this increasing tendency for strong hand people to come in and buy it and put it into cold storage, whether it's like retail hodlers or it's these institutions that say, "Hey, we have this 5-year view. We're going to buy Bitcoin and just kind of stick it away." And so, yeah, if you start to see that on a national level more, that's kind of I guess the early signs of kind of a hyper Bitcoinization, or basically that
Mm.
Bitcoin quickly ascends at least to the say the kind of the scope of gold, where it becomes an actual like recognized international reserve asset, right? So right now it's not there yet. Most countries don't take that seriously as a reserve asset. Um, but the next level up is kind of that gold like level where you're worth several trillion dollars and that you become commonly held in reserves.
Well, it's what Pierre Rochard calls the speculative attack, in that
Yeah.
you buy, print, borrow sovereign currencies to buy Bitcoin. And it feels a bit like to me, yeah, Lynn, you can probably predict this better than I am. But if El Salvador was to do this, and then other countries look at doing this, the bond rates on the Bitcoin bonds could actually start going higher. And could this be a scenario where it's almost like inverse to the like US treasuries, in that we're seeing lower and lower rates on like US bonds, and that Bitcoin bonds could go higher and higher because they're more reliable?
Well, it depends. I mean, generally, if a bond is considered safe, its
Oh,
yield
it's a
should be
lower rate.
pretty low. Now, for example, like let's say El Salvador's Bitcoin goes up a lot, and then they refinance this amount of debt in the future, they could potentially get a lower rate because now they have a lot more collateral backing up that loan. The alternative is that they could keep the rate roughly the same, but issue a lot more bonds. And so far, we've if we look at kind of the catalog of who's issued bonds, MicroStrategy's been the obvious example. We just saw Marathon, I believe
Mm.
they're the largest Bitcoin miner. They already actually bought Bitcoin on the open market, and now they issued more. They issued debt in order to basically combination of buy Bitcoin, buy miners, just kind of general expenses, and they actually discussed this on the Bitcoin Mining Council, the prior kind of live stream they had, where a couple of the miners talked about that basically during the Sailor playbook on their own balance sheets. So you don't really see that among gold miners, for example. They don't like issue bonds to buy more gold. They sell the gold that they get. Whereas an interesting thing that we're seeing in the mining space is that they're not really selling the Bitcoin that they're mining anymore. At least a lot of the ones in North America, they're just hodling it on their balance sheet. And then some of them are also going a step further and actually issuing various types of liabilities to buy more. Then you see El Salvador do it, and so generally it's companies or countries that have kind of high conviction and that don't feel they have a lot of career risk for doing it, right? So Saylor owns a large percentage of his company, especially the voting rights. Miners, obviously, because their main purpose is to own Bitcoin, they feel they can do it. El Salvador, they feel it. I guess he feels like he's in a tight spot. The country, they want to do something big rather than kind of these incremental changes. So he's kind of going for it. I think the reason you see it slow among other countries or corporations is that there's career risk, right? So there's not a lot of gain for the person in the treasury of that company that if they get that right, at the size they would do it, they probably wouldn't, they'd get congratulated, but it wouldn't be like it changes their career. Whereas if they're wrong, they lose their job. And so there's that career risk, and that's why you generally see more bureaucratic institutions move slower, whereas these smaller, more periphery entities are able to just one decision maker just kind of makes the call and they just kind of push forward with it.
Yes, fascinating. I sometimes wonder if our beloved Satoshi is around and watching all this, and admiring what's been happening, because I'm pretty sure he wouldn't have predicted that we would have had these huge mining operations, and then governments issuing bonds to create mining operations. Like, how this has evolved, I don't know. It fascinates me. I don't know if you're equally fascinated by it.
Oh, definitely. And I mean, I think it's funny because we have Hal Finney wrote about this back in like, was it 2010, 2011? He kind of imagined how big it could get. He was one of the more vocal people describing how big it could get. And so I think he'd be maybe less surprised. Um, and
100 million a coin, I think he said, didn't he?
yeah, yeah, we also talked about just like if banks start using it as their reserve asset, and basically he predicted kind of the financialization of Bitcoin. Um, and the quote that always sticks out to me from Satoshi is that he said he's sure that in 20 years it would either have tremendous volume or no volume. Like
So you
basically
should
it's
probably buy some, just in case.
yeah, yeah, and it's basically his overall point was that kind of like he's not sure it work out, but it's either gonna be a tremendous failure or it's gonna be a tremendous success. Like is there's not a lot of middle ground in his view. And so far, obviously, 13 years into that 20-year vision, it's on the tremendous success path, right? So he's been correct about that.
Yeah, and I don't see us going backwards from here. I mean,
I don't.
yeah, I mean, I just it feels like we've gone too far now. It feels like we have the regulatory protection in the necessary markets. Not enough here in the UK or Europe. Unfortunately, we've just not been forward thinking enough. And I think the UK specifically missed out on an opportunity with Brexit to be a leader in this, which is a shame. And I think Europe is being massively left behind by El Salvador as well as the US. But I feel like the US is very forward thinking with this. I feel like if you have the protection, the regulatory protection of the US, then you kind of have most of the rest of the Western world. But no, it's fascinating. Anyway, also, I need to talk to you about inflation. I know we discussed this in a Spaces recently, but not everybody would have joined us for that. And we saw the very surprise figures coming out of 6.2%. Since then, we've had the UK announced figures of 4.2%. Still can't seem to be able to explain to my friends why this is an issue. I've been telling them for quite a long time and trying to get them to listen to the podcast. But what were your reactions when you saw 6.2% inflation?
So kind of that it was like in line with expectations, maybe slightly on the higher end. Because my overall window that I was expecting was I wasn't sure if it was going to be higher than the prior number. My only conviction was that it would be around that height, so that it wouldn't really be going down yet. And so there was kind of that big range where nothing would have surprised me. If it was over 6.5%, I probably would have been surprised. It's also partially that you're not just expecting inflation, you're also expecting how they're going to measure inflation, right? So for example, a big component is the housing component. That's what's driving up a lot of the 6.2% figure that we're seeing in the US now. So earlier in the year when we were getting, 4 or 5%, housing was a big drag on that. And even though housing prices had gone up a lot, owner's equivalent rent, which is actually what's in the inflation basket, had not yet come up yet. It was still a very low number. So that was actually pulling the average down. But now we're starting to see that those figures are pushing it up. So rents in the basket are going up, and owner's equivalent rent. Now they're still behind what you'd actually expect if you look at what housing prices did, and if you look at like data aggregators for what rent prices are actually doing. So these are actually still understated. So when you're kind of anticipating inflation print, partially you're trying to figure out what's inflation going to be, and then two, you're saying what is the government's measure of that inflation going to be, which is that's why I don't try to predict it too specifically. I just know a range that it's going to be in, and so generally we can look at least another quarter or two and say that because of the real estate situation, we're probably going to have sticky high inflation for at least those 2 quarters. And then, as we move forward, we'll get more and more visibility, right? So it's possible that could eventually top out for a period of time and kind of, relax, or something else could happen. We could have another energy crisis. We could have some sort of issue like that that gives us another leg higher. But at least with the visibility that we have, while it's hard to say the exact number, it's rather straightforward to say that inflation is likely to be elevated and sticky for at least 2 more quarters.
Okay, could it go higher? I mean, look, one of the criticisms that we heard from the likes of Preston Pish, our friend, and Greg Foss, is that this really, like, 6.2% is like the lowest number they could get to based on how they measure inflation. But I mean, most people are saying that everything they're buying, whether it's petrol or houses, everything is much higher than 6.2%. So there is the suspicion that inflation is much higher when. And do you know what? Just to add into that, who was it I saw recently said that the strange thing about inflation is, like, inflation is very personal because it depends what you're spending money on. Like, the government measures it against a basket of assets, but the things that you buy might be a lot higher. But do you think we could be going higher than 6.2%?
I do, yeah. Basically, especially if it shows up in the owner's equivalent rent, which is like a third of the basket. I mean, as a data point, Invitation Homes is like the largest homeowner in the U.S. It's like a publicly traded, business that owns a lot of single-family homes, and they raised rents by like 11% year over year on average.
Wow.
And that's that they have this, big nationwide, complex of homes, and that's not showing up yet in the CPI. The CPI, when they look at rent, they're calling it something like 3 or 4%. They're not calling it 11%. And so that still has, I think, a runway to go. So I wouldn't be surprised to see 7 or 8% official CPI prints. Now, again, I don't
Wow.
have and I don't have a specific number because you're partially you're trying to estimate the quality with which they're going to measure the number rather than just predicting the number. And so that's hard to say what they're actually going to report that the number is. But based on the next 2 quarters of housing growth, that's certainly possible, unless it's offset by something else. If we have some sort of collapse in auto prices or something like that that kind of offsets those housing prices going up, that could maybe keep it in the 5 to 6% range. But so there's a couple variables involved and levers to do. But the high conviction thing I would stick to is that housing inflation is going to at least keep it sticky around roughly where it is, or higher, for the next 2 quarters, and then we'll need more visibility and data points to look out the next couple quarters.
What kind of number would shock you?
I mean, no specific no. So I guess the high end right now, so broad money supply growth in the United States is currently 13% year over year, roughly.
Okay.
And so that's you can briefly have price increases go up faster than money supply growth. Um, Not really in a sustained way. As you saw that briefly in the 70s, you didn't really see that in the 40s. So generally 13% is kind of my rough end high estimate. Now it doesn't mean, again, you could touch it for a quarter. It's hard to sustain above that. So generally when you start to get into if you were to breach maybe 10% kind of official reported inflation, I'd find that pretty surprising at the current time. But overall, I mean, my base case is just sticky and high. So
Yeah.
it's one of those things, and it also a lot of people have hubris in that they try to measure it exactly or say exactly what it's going to be, and of course you're combining multiple factors here. So one is you're combining actual things we can measure, like part of why I expected high inflation is because I already saw this big increase in the money supply and was pretty sure that was going to trickle into price increases, was what we're seeing now. So there's that. It's somewhat measurable, but then you also have psychological things, right? So how people's tendencies change, and then you have details like, is the winter going to be cold or warm, because that can affect energy prices, which then can affect
Hmm.
everything else. So there's multiple variables that I wouldn't even try to fully guess and be like, okay, it's going to be exactly 8.2%, give or take zero point 0.1. Like that's too specific. But I can
Yeah.
look at it and say, okay, here's the money supply growth rate. Here's the historical relationship between money supply growth and price increases. Then we have this big range around the price increases because we actually have to determine how accurately they're going to measure that, which I don't have a super ton of faith in. So yeah, basically, when you start getting to double digits, I'd be surprised. At least in the current environment, if we see an acceleration of money supply growth, then that changes that calculus.
So if we were to see, say, plus 10% inflation, I think 10% as a marker would be considered very high. What kind of reaction do you expect to see? Do you think that would force the hand of the Fed? Do you think they would have to change things? Do you think we would see interest rates, raised?
I think you would see more reaction, yes. Now the problem is they can't, in order to give real yields in that environment, you'd have to raise rates to like 11%,
Hmm.
and that's not going to happen. So they've been talking about potentially accelerating their taper, right? So currently the Fed's plan is that from now until about mid 2020, no 2022, they're going to be reducing their rate of asset purchases, to eventually maybe get to zero, and then from there they're talking
Do you
about.
believe them?
So I do believe that they're going to try that. Yes. Now they left it open because they have a minimum that they're going to buy, but they actually don't have a hard cap. If there's any moment of dysfunction in the treasury market, if there's any sort of illiquidity problems, they can just buy more that week, right? So they're actually not fully committed to that plan. That's kind of that they basically are saying that they're committing to a lower minimum, that they're going to buy over the period of time. But I do think that they're going to slow down their rate of asset purchases. There are various signs that, basically the banks are already so stuffed full of reserves. It's not doing a ton anyway. And because of certain collateral shortages, there's this demand for T-bills. Again, it actually goes back to the regulation. There's all this regulation that basically forces entities to own T-bills. And so basically, I do think that you're going to see a reduction in asset purchases combined with the fact that the Treasury is going to be probably reducing its average maturity of bonds, so financing more of its debt with shorter duration Treasuries, because that's where the demand is. And so I do think they can do that for quite a while. Now, I think the bigger question is how long can they do that, right? So I have
Hmm.
little doubt that they can do it for a period of time. I have doubts that they can sustain that. So I think eventually you would get another kind of slowdown, and you'd have another round of QE. And then while this all plays out, I don't think rates are going to get anywhere near being positive real rates, meaning that even if they start to say, okay, this inflation's a problem now, we're getting 8, 9, 10%, or say it's sticky around 6%, they say, you know what, we're going to start raising rates by a quarter, we're going to go up 0.25%, at a time. That just doesn't cut it, right? So I think around the margins, you'll see directionally trying to tighten. But it's just not necessarily sufficient to actually make that money worth worth holding.
Do you think anyone has a harder job than Jerome Powell right now?
I mean, I always say I wouldn't want the job. I mean, that I'd have to say there's obviously manual jobs that are much harder than that. But yeah, from in a financial standpoint, it's choosing various ways to lose. There's no way to win,
Yeah.
and you're just trying to lose slowly.
Yeah.
And so I'm surprised. I don't know why he wants I don't know why he wants another term, because he's
Well, he
already
just got
rich.
it.
Yeah, he just got announced to have it, and he's already rich, and I don't know why he doesn't want to just go work for Wall Street again and just get out of this. I don't know why. I don't know.
He's going to get blamed for everything.
Yeah, I mean, I always point out that so back in the Greenspan era, in the 90s and the early 2000s, I think the Fed had meaningfully different decisions they could make. That they didn't have to go down the route they did at all, and they did. They kept cutting interest rates. They kept basically helping Wall Street wherever they could, and that they've essentially trapped themselves because now there's so much debt that they can't ever realistically raise rates, anytime soon without a major currency devaluation happening first. Um, and so now it's just around the margins they can make mistakes, but really they're just so trapped into a corner that I don't even blame them anymore. In some ways, it's like
Hmm.
that they've the people that are running it now. I'm like it's a mess. So I wouldn't want that job.
Well, a lot of Bitcoiners talk about ending the Fed. Like, have you ever gamed that through? Do you think it's possible to not have the Fed? Like, realistically?
Yeah, there have been. I mean, in the United States, we went through periods of time where we didn't have a central bank. The Fed is our third
Okay.
central bank. And
Okay.
so
I didn't know that.
yeah, basically, we when we were founded, we had one, and it had an expiring charter, and they let it expire. Then they had another one that one expired as well, and the current version, the Fed, was created in 1913. During the late 1800s and into the early 1900s, there was no central bank, and essentially how that works is that there's banks would have, like, in that environment, they'd have gold as their reserves, or at least a lot of their reserves, and they'd issue liabilities against those reserves. And if they go bankrupt, they go bankrupt, and
Right.
you'd have to be very careful about institutions that you put your money in, because you can lose it. But on the other hand, you don't really have that kind of that central control. Essentially, in most markets, like, basically pricing is really important. We generally, we would balk at, say, if the Treasury Department set the prices of turkeys, right? We'd be like, no, we want supply and demand to determine the price of turkeys. But basically, in this modern central banking era, they control the price of money, which is interesting because it's one of the most universal prices, right? They set short-term interest rates, they override market forces, and they determine what they believe interest rates should be. Whereas in that more free banking type of model, you'd have different banks set different interest rates, and they'd have different levels of risk. And we kind of see a microcosm of this in the Bitcoin space, where you have these different kind of, quote
Mm.
unquote Bitcoin banks, and some of them are perceived as riskier than others, and they have different rates compared to others. And they're not FDIC insured, so if you deposit assets and then that entity goes as financial problems, you might not get those back or not get all of them back. And so you generally have a similar environment there, where this one bank might have a bad reputation. They might have had a history of issues in the past. They might be luring customers in with higher deposit rates that might or may not work out. And then you might have very conservative institutions that are much more perceived as having a lower probability of having any sort of problem. So yeah, I do think that there are structures that work without a central bank.
Okay, so it's just a reputation market. The banks, it's free banking. You have a reputation market similar to what you have with bonds, right? I mean, the different rates of return depending on whether you believe that country can, how much of a risk that country is. You'll get a higher rate with Argentina than you would get with the US. Do you prefer that model?
I think longer term, yeah, that's an ideal model. I mean, I think preferably you'd have institutions set interest rates rather than a central entity. Even just
Yeah.
the United States. I mean, we're a country of 330 million people, and the right rate for the South might not be the right rate for the North, for example, right? And so there could be regional differences, let alone individual banking differences for what the natural interest rate should be in that market. And so I think that's something to be aware of. And so overall, that's kind of it's kind of comes directly tied with sound money because the current system, the way the whole fiat system works, is kind of inherently tied to central banking. It's hard, you can't really separate the two. But yeah,
Hmm.
if you had an environment where the actual reserves were some sort of sound asset, whether it's gold in the past, whether it's Bitcoin in the future, whatever the case may be, then you can make that free banking model work because their reserves are not tied. They're not also liabilities of any other entity. Now they can kind of do sharing, so they can a bank in addition to holding gold can hold treasury bonds as collateral. They could hold another bank's say liabilities as collateral. So you have to be careful of things like that. But as long as that the base of it is some sort of kind of bearer asset like gold or Bitcoin, then it's workable.
Yeah, I guess why that's when we have Bitcoin. We don't really need a central bank, which is great. Okay, we should probably finish talking about Bitcoin. So we set a new all-time high recently. We tagged 69,000, and we dropped down again. And this second leg of the bull market just doesn't seem to be getting going. Seeing different people have different perspectives on this. What's your take at the moment with Bitcoin, Lynn?
So overall, I would say this recent leg up kind of looks like the leg up we had from July. So it went back then it was all the way down to 30,000, and then it popped to over 50,000, and then it corrected down to 40,000, and then it popped all the way to well over 60,000 to new highs, and then it's since corrected down to the 50s. So far that's actually pretty symmetrical. That's you generally don't see bull markets go straight up. So if it were to stabilize in the mid 50s, then start heading higher, that's actually super healthy. That's really healthy.
Hmm.
I think the big concern you'd have is if you start breaking down below the mid 50s, then you're in more of a consolidation pattern. So that's not necessarily super bullish over the say the short term or the intermediate term. Um, you've had people on your program that are like on-chain and analysts, so they cover that space more than me, but I do pay attention to some of that. Some of those are a little bit bearish, but I would say the majority of the ones I look at are still bullish. So overall, basically, like we mentioned before, the number of Bitcoin on exchanges keeps reaching new lows. You have to go
Mm.
back all the way more than 3 years to find a period, and that this is unlike any prior cycle. This is kind of the big wild card that makes this cycle so unknowable is that in all those previous cycles, the number of Bitcoin on exchanges kept going up. At most, you'd have a few months where it went down. It just structurally went up because you had the growth of exchanges, you had a lot of new supply coming to market because you still had a pretty kind of inflationary distribution schedule back then. But over time, as the halvings keep happening and as just the exchange industry's matured, now you have a structurally declining amount of Bitcoin on exchanges, and so that over the long run is structurally bullish. So I'm still bullish overall. But yeah, basically we want to kind of watch certain levels and see if we're still making higher highs and higher lows, and if we overall have kind of intermediate term momentum, or if we have to maybe think out another year before we start to see kind of crazy upside action. I try to avoid these specific price targets that people make, and they have like a specific model, and they say this is what Bitcoin has to reach by this time. I when I've kind of been asked to give one, I do give price targets. So I called for the $1 trillion market cap back when it was like a third of a trillion. We got that, and then I've been eventually looking for 100,000. either maybe by this year or kind of the first half of 2022. And I still think it's, at least for the 2022 version, I think that's still certainly on the table as a viable option. And I think, but the longer term picture is what I'm focusing on.
All right, Lynn, I think we can finish up here. Always amazing to talk to you, and really looking forward to seeing you next, because we're going to record a show in person, which is going to be entirely different because we've never got to do that, which is always my preferred way. I think we should do a review of the year, talk about what we think is going to happen next year, but I'm really looking forward to that. I've loved every interview we've done this year, so thank you, and I will see you very soon.
Thanks for having me. And yeah, we ran into some technical issues this time, but next time we'll be in person, so we'll have a much smoother one. So hopefully people enjoy this.
Okay, well, I will see you soon, Lynn. Take care.